Good morning, everyone. Welcome to our webinar this morning, which is titled Keeping More of What You Earn in 2023. So the purpose of running this webinar this morning is really to sort of focus on the fact that times are quite difficult at the moment. We've got inflation running at about 10%, obviously with the living crisis and everything like that. And interest rates are increasing as well. So I think it's quite a difficult time for businesses and individuals at the moment. The idea of this webinar is just to try and recap on some of those allowances and reliefs that are available, and also to review some of the changes that have happened for the upcoming year, just to try and help make things a little bit better, I suppose, and retain more of what you're receiving. The webinar is going to be hosted by myself, Kirk Vaughan, and also my colleague, Shelley Clark. And we've got an agenda on screen there. The webinar is going to kind of be split into two. We've got quite a bit of material to cover, so we're going to kind of go through things in a little bit of detail. Naturally, if there's anything that comes up that is of interest and you do want more details on things, then feel free to contact myself or Shelley. Or if you've got another contact at Nightslow, then feel free to contact them as well. And yeah, it's going to be sort of focused on business tax to start with, and then we'll be moving on to personal tax matters afterwards. So I'll pass across to Shelley to explain what's happening with corporation tax rates at the moment.
Yeah, good morning. So corporation tax rate rise. As most people are aware, from the 1st of April, we had that increase to the new top rate of corporation tax up to 25%. So that was from 19% to 25%. So quite a significant change there. For businesses whose profits are 50,000 or under, you're still going to be at that 19% mark. Those over 250,000 will be at the 25% mark. And those in between those two bandings, you're going to be at what we call marginal rate. So for most businesses, you're going to fall into that rate, and it's going to be sort of topping out at the high 24 mark. So yeah, lots of tax planning to be done here to make sure we're ready for this, because it is going to have a big impact on cash flow for some businesses, and it's going to make all of this tax planning really beneficial now to ensure that what you are doing in the ways of reliefs and allowances are at the best possible timings to make sure you reduce your exposure to this 25% banding. So in terms of what planning we can do with any losses that you're generating, typically what we do with losses is you've got an option to either carry them back 12 months or you carry them forward against future profits. Historically, when we were at the same corporation tax rates, quite often we do a carryback claim, and that would get you a cash injection at the time. So for a lot of businesses that are in a loss position, actually the cash injection was really valuable. What we're more likely to be doing now, especially while we're looking at year-end accounts, is actually considering whether we should carry those losses forward and utilise them in the future against possibly a higher rate of corporation tax. This is going to be on a very individual business basis. We're going to have to look at each individual position, look at cash flow, look at why those losses arose and what the year forward is looking like. But yeah, very, very important there to consider, do we carry those losses forward? In terms of expenditure, it really comes down to timing and amount of your expenditure now. So it's really critical to start thinking about when we are doing key tax planning events here. Big example is obviously your pension contributions. So company making contributions into your own personal pension scheme if you're a manager owner. More and more valuable now. So before you were getting the 19% relief, now you could be looking at up to 25% relief. So it really is worth looking at that. Other things to consider is if you do currently offer company cars, it's actually, would it be more beneficial now when you throw in the higher interest rates, as Kirk mentioned, would it be more beneficial actually to purchase that company car rather than have it on a lease or a hire purchase? So lots to consider there in terms of timing of expenditure and amounts of expenditure. For some businesses, there actually will be a benefit of changing your accounting period, particularly if you've got a lot of seasonality within your business. And in some cases, we might even look to shorten accounting periods. just to factor in the timing of when these bans came into place from 1st of April. It will be a business per business basis, but that could be an option for some people, which will add quite a significant benefit there.
Thank you, Shelley. I'll just highlight that there is a Q&A box on your screen. So if you've got any questions throughout the webinar, feel free to post your questions, and we'll save a bit of time at the end to try and run through those. Just wanted to run through capital allowances. There's been quite a few changes in this area over the last few years. So capital allowances is the way that you get tax relief on any capital expenditure that the business makes. We've had the annual investment allowance, which gives you a full write-off against any capital expenditure. This limit was £200,000. It temporarily got increased to £1 million in January 2019. That's now been made permanent. So we have got a permanent allowance of £1 million now. There are some assets that don't qualify for this full relief or annual investment allowance. And the most notable expenditure that doesn't qualify are cars and anything which is purchased from a connected party. So that might be a shareholder of the business, it might be a business under common control or something like that. Up until March 23, we also had the super deduction. So for main rate pool additions, this gave you 130% relief on the asset you acquired. So if you acquired an asset for £10,000, you'd reduce your taxable profits by £13,000. The idea of this was that it increased your tax relief to give you a similar level of tax relief that you're getting now following the increase in tax rates that Shelley just mentioned a little while ago. Like I say, this is now ended and it's been replaced with a new relief, which is called full expensing. Essentially, this does exactly the same thing as the annual investment allowance. However, full expensing is uncapped. So you can spend as much as you want. And if you've got expenditure in more than £1 million, you can get the full amount offset against your taxable profits. You only get 100% relief on main pool assets. Special pool assets, you only get 50% relief. So that would mainly be things like integral features. So if you've built a property or refurbished a property or something like that, then some of those assets like the plumbing, the lighting, electrical bits and pieces of the building, that won't qualify for the 100% relief. So what we would be looking at when we're preparing the accounts is trying to make sure we're maximising the reliefs as best we can. So for example, we might full expense all the main pool assets and then look to use the AIA, the annual investment allowance, for any special pool assets. Once we've utilised all those reliefs, we've also got the normal writing down allowances. So any asset in the main pool will get tax relief at 18%. The special pool will get 6%. We've also got the structural buildings allowance, which for any new building, you get a 3% allowance on any cost that doesn't qualify for capital allowances. So that's going to be typically the building itself. So the walls, the roof, the floor, things like that. From a tax planning point of view, capital allowances is quite a useful tool to look at your profit projection for the year. So before you get to the year end, look at the expected profits. We can understand what your tax liability is likely to be. And that's the perfect time to try and decide, when in actual fact, is it worth bringing expenditure forward to get the tax relief against the current year we're looking at? Or would it be better to push it forward to next year if there's going to be more tax relief received next year? And things that might impact that, for example, is what tax band your profits are in. So like Shelley was mentioning earlier, the first £50,000 of profits are taxed at 19%. The next bunch of profits are taxed at 26.5% in the marginal profit area from £50,000 to £250,000. So, you know, it might be that you can get higher relief by picking and choosing what period you're going to incur that expenditure in. Research and development is a very valuable tax relief for limited companies. So this only applies to companies, not unincorporated businesses. The way it works is essentially you get, well, there's two different schemes, but essentially you get an additional relief for costs you incur that relate to R&D projects. There's quite a few slides on this, and I don't want to go into the detail of the claim itself. I really want to try and concentrate on how to identify whether a claim can be made, because I think that's the key part to it. There's been quite a few changes in this area, and HMRC are trying to make sure that this is utilised in a more fairer way. So at the moment, I think there's a lot of businesses out there that should qualify and should be able to access the relief that aren't claiming it. And at the other end of the spectrum, there's a lot of businesses that are maybe abusing it a little bit. So the Revenue have brought in some rules to try and target this relief in a better way. We'll quickly run through those in a little while. In terms of whether you qualify, the company must be carrying on a project that seeks an advance in science or technology. Now, that suggests that to qualify, you need a scientific lab in your business and you need scientists wearing lab coats or something like that. It's not necessarily the case. I've got some good prompts, I think, later on in the slide, so I'll just touch on that in a little bit more detail later on. But there's a few questions later on just to sort of have a think about, and if you answer any of those yes, then there might be the ability to make a claim. So what type of R&D expenditure qualifies? Well, the main costs that qualify are wage costs. So the proportion of wage cost that relates to the qualifying R&D project. Another common one is subcontractor costs. So if you get external workers to work on the R&D project, we can claim 65% of their cost against the R&D claim. That assumes that the subcontractor isn't a connected party to the company making the claim. If it is connected, then the amount you can claim tax relief on is restricted to the subcontractor's cost of providing that work. Another common cost that we see claimed is consumables. So this will either be direct consumables, which will be materials that make up prototypes or anything like that. It's just important to realize that if you do put materials towards a prototype and you end up selling that prototype on, you can't claim the material costs on goods that are effectively sold on to the client. But if you have a prototype that isn't sold, so it's just a testing facility, I suppose, at your business, then we can claim the material cost on that. We can also claim a portion of water, power, software costs, trials, and things like that. Obviously, we can help you once we've identified a project to work out what costs qualify and maximise any claim. We've also got a bit of a run through of things that don't qualify as R&D expenditure. So land, production, distribution costs, capital expenditure, patents and trademarks as well. As I touched on earlier, there's two schemes. There's an SME scheme, which is targeted at small and medium-sized companies. So to qualify for this scheme, you have to have less than 500 staff and the business has to have a turnover of 100 million or a balance sheet total of under 86 million. And that's the whole group total, not necessarily just the sole company. So if you are under those limits, then you can access the SME scheme. That is unless you are barred because you're either state funded, so you receive government grants, or if you are subcontracted by a larger company to do R&D projects. If you don't qualify for the SME scheme, the small scheme, we've also got the R&D expenditure credit scheme. So this is effectively allow you to claim a tax credit on the qualifying costs of the business. And it's not quite as beneficial as the SME scheme, but it does still provide a significant benefit if you are qualifying for an R&D claim. So there's been quite a few changes in this area. And I just wanted to sort of run through the rates of relief and also the changes that have come in. So in terms of some of the changes, from April 23, you now have to notify the revenue that you're going to intend to make a claim. So if you're a new claimant, so you've not made an R&D claim before, or you haven't made a claim in the last 3 years, you need to notify the revenue within 6 months of the end of the accounting period that you're going to make a claim. So it's really important to understand if there is a project that qualifies, we kind of need to get in there, tell the revenue we're going to make a claim, and then that gives us more time to actually make the claim. Previously, you had 2 years from the end of the accounting period to make a claim. So it's kind of shortened the timescales to make a claim by 18 months. And importantly, you might have to notify the revenue before you actually get your accounts finalized and prepared. So it does change the dynamics there a little bit. There are some other subtle changes as well. So you're only able to claim subcontractor costs limited to work in the UK, and data purchasing costs are also now included as well. But I don't think that's going to impact too many businesses. In terms of the rate of the relief, these have changed recently. So the small SME scheme, you used to get an additional 130% relief on the expenditure you incurred. So if you incurred £10,000 on a qualifying project, you would be able to reduce your taxable profits by £23,000. So that equates at saving 43.7p in the pound you spend on R&D. So it's quite a significant R&D saving. That rate has now been reduced to 86%. So if you spend £10,000 on R&D, you will get a tax deduction against your profits of 18,600. There's also the ability for the small scheme to exchange any R&D losses to a tax payable credit. You used to be able to claim a 14.5% tax credit. And for a lot of businesses, that's actually really quite useful because they're normally through the development stage, the business will be loss making, and having the cash is really quite useful rather than having the losses carry forward. If you do see yourself being profitable, it makes sense to carry forward the losses because you'll get tax relief at a higher rate, up to 25%. But like I say, often the cash injection is more beneficial there. That rate of 14.5% for the tax credit is reducing to 10%. Although if you're an R&D intensive company, which means you spend at least 40% of your total expenditure on R&D, you can still claim the 14.5% tax credit. Just finally, on the RDEC scheme, the Research and Development Expenditure Credit Scheme, the old rules were that you received a 13% taxable credit in the business. So you received a tax credit from the revenue, which was then taxed in your business. That's gone up from 13% to 20%. So it's slightly more beneficial now for the larger scheme. The only other change that I would highlight is that in August 2023, the revenue are going to add additional information to support a claim. There's quite a few details of the information you need to now be sending to justify a claim. To be honest with you, most of that information should be within a good justification report anyway, to set out what the projects are, what the expenditure is, how the business qualifies, and things like that. And again, we can help you with that if you need us to pull together a report. So like I mentioned earlier, the key thing I really want to take away from today is understanding when your business may qualify for a relief. And I've got a few questions on screen here that kind of highlights the kind of things that would indicate there might be a claim there. So first one, have you developed your own software? If you have, there's a good chance you could make an R&D claim. Have you developed internal processes that reduces costs and improve production time? So it might be that you're actually doing the same thing. The output from what you're doing is the same, but you're doing something that's, more efficient. Well, that can qualify for R&D as well. If you're carrying out design work that enhances technology, again, possibility of making a claim there. anyone who's in manufacturing, it is possible that you're making a claim, because very often when you're manufacturing things, you're coming up with new processes or ways to make things, which means you're using less materials, less wastage and things like that. And again, that's all indicating that there's R&D there. If there's any uncertainty as to how that process is gonna pan out in the end. You can use the same technology in different ways or in different industries. That can still be qualifying R&D. If you're combining two or more existing technologies to try and come out of an output, then again, that can qualify for an R&D. I think the key thing is when you're doing a lot of these, there has to be an uncertainty from the outset as to whether that's going to work or not. I think very often that is the case, because you're trying to, you know what you're hoping might happen or what you're trying to achieve, but until you test it, you don't really know whether it's going to work or not. The final one is if you're pending patents for any products or services, that's normally an indication that you've developed something, you want to protect it, hence why you're going for a patent. And again, it would suggest that you might have an R&D claim in developing that product. So I think, yeah, that could be quite useful there, just to sort of, you know, cover off or help identify whether you've got a claim. And like I say, if you're in doubt and you think you might have a claim, feel free to get in touch.
Excellent. So I just want to touch on a few business tax planning ideas, and a lot of these should be very familiar. It should be things that a lot of businesses are already doing, but given the changes in the environment we're now in, it's just worth taking this opportunity to look at them again. So first and foremost, salaries. So historically, we've normally gone down the line for most businesses for the directors to take low salary, high dividends. That's your sort of standard tax planning. But now with the increase to the 25% corporation tax rate, there could be some circumstances where actually that's not going to be the most tax efficient position. We have to weigh in here the individual's earnings, what other sources of income have they got, how much income do they want to take from the business. But it's a good opportunity to review this level and just make sure we are being as tax efficient as possible here. Other things to consider, of course, your benefit package. So this can be your benefit package to your owner managers. It can be your benefit package to your employees. So take this time to actually look at that package. What are we offering? Is it competitive? But also, is it tax efficient? So do we offer private medical insurance? Previously, we were getting our 19% corporation tax relief. Of course, there's the P11D cost to it there. But is actually now we're going to be getting potentially 25% tax relief. Is it suddenly a bit more appealing that we're going to offer that to all employees or to perhaps management? Other things like, of course, your company car. So we're all very aware that company cars have been used and the rates of company tax benefit have been rapidly increasing on those 30 diesels and your petrols. So most businesses have started going down the line of looking at hybrids or pure electric. Now really is the time to look at those vehicles. Have you perhaps got one that you've bought after its lease has expired, but actually it's a gas guzzler, it's costing your business and your employees a lot of money there? Do we actually have an opportunity to look down perhaps a pure electric route, where you're looking at 2% benefit in kind charge there on the list price? So really good opportunity just to look at that and just review what are we offering for company cars, what is competitive, what do we want to offer, but are we being as tax efficient as possible there? Then we've got our enterprise management schemes. So these are very tax efficient ways of giving key employees shares in the business. So typically you see these being used to try and tie in those key individuals, to really lock them in. Perhaps they're someone that you look down the chain of command and you think, actually, I can see them really doing well here. I want to retain them. Using these EMI share schemes, what we can do is get them involved in the business, get them a shareholding in the business, which really does help tie in those employees. and it can be done very tax efficiently. What we must be looking at doing here is making sure we go down the route of a HMRC approved scheme to make sure it is tax efficient. So there's lots of planning need to be done before we go down this route. So it's a conversation to have once you start getting a feel for that individual, perhaps a group of individuals, start having that conversation with us now, so we can make sure we do this as tax efficiently as possible for you. In terms of expenses, this really is just making sure, quite simply, have you and all of your team claimed all of the relevant expenses for the period? So have you made sure that everybody's put in their mileage claims? So hopefully a lot of you or the team are all using your mileage apps to track those miles. So it should be a very quick exercise to log all of those miles and get them into the system. Just making sure, as we're coming, especially up to year end, have we made sure everyone's got our expense claims in? Have we put all of those costs that we have suffered, are they in there against that income? Because now more than ever, that could be the difference. By getting that 25% corporation tax relief, it's well worthwhile having that exercise. Other than that, we've got your profit extraction routes. So are we effectively taking dividends as tax efficiently as possible? So looking at all of the above, so your salaries, your benefits, any share schemes, expenses, and then throwing your dividends. Are we being tax efficient with each individual and each business to make sure you are taking home more of what you earn as tax efficiently as possible there? Given the recent changes, it's well worth revisiting that to make sure we are being tax efficient. And if we take a look at personal tax planning, so we've got various points on here I just want to touch on. So this is much more looking at owner managers, employees, you can sort of spread it across the board. A lot of these different sections will apply to different groups. The key thing to bear in mind here for income tax is the change in our additional rate band. So in the budget, it was announced that the additional rate band is being pulled down from the £150,000 to £125,140. What this means for a huge number of individuals, they're going to be pushed into that additional rate band this year. And that's looking at your 45% on salaries and benefits, and then 39.35% on dividends. So really, really expensive change here if you don't act on it now. So just bear that in mind, because we've got quite an ugly tax rate from the 100,000 to the 125,000 with the loss of the personal allowance. And then there's no relief after that point. You're straight now into that additional rate band. So just being really careful with there, looking at the income level and making sure we're efficient. Interspouse transfers, this isn't just income tax, this is also your capital gains. So have we made the most to maximise both individuals' capital gains and income tax rates and allowances? We've got various options here with exempt transfers, bringing husband or wife into the business and giving them a role in the business. Lots of things that can be done, and the sooner you do it in the year, the better, so that we can plan for that. Other things to consider, not just necessarily for owner managers, but also perhaps for some of your key employees or the team in general, is do you want to offer the exchange of salary for benefits? The biggest one here that's going to have the most appeal is going to be your pension. So what we can do here is you can reduce your salary down and the additional amount goes straight into a pension scheme for that individual. So that will reduce your taxable income. Also, the money's still going into your pot, and it's very inheritance tax friendly doing it this way. But it's just worth bearing in mind there. Do you or all the individuals actually want the cash from their salary, or can we save them, especially bearing in mind that additional tax rate band? Can some of that go into their pension scheme? New company car, so touched on this already in terms of your corporation tax, but as an individual. So as we know, your pure electrics or your very high range hybrids are the way to go in terms of company car benefits, because it's very costly to go down the route of a petrol or a diesel now, both in terms of your P11D benefit charge, but also the lack of capital allowances available for those in the business. Do we need to look at the timing of these? So have we got anyone in an old vehicle? Do we need to accelerate it? Do you need the company car? All of these things just need to sort of consider on an individual basis as to what's going to work for you to be as tax efficient as possible. So dividends and bonuses, really consider here the timing of these, because that's going to make a big difference. So making sure we're bearing in mind the personal tax year end 5th of April, making sure we are looking at what is your total income for the year. Are you pushing up over that 100,000 bracket, so you're starting to lose your personal allowance? Do you think your income next year is going to be higher or lower? Just looking at the timing of when we're going to do these events make a big difference in terms of tax planning now for individuals. Small point here of your director's loans. If you are loaning money to your business, so perhaps you're in a startup phase or a particular period of growth, so you're putting a little bit of extra funding behind that business there, is the business paying you interest on that loan? So what we can do here is utilise your saving allowance. So if you're a basic rate taxpayer, you've got £1,000 saving allowance. If you're a higher rate taxpayer, it's restricted down to £500. It's interest income that you can earn at 0%. So if you don't generate a significant amount of savings interest elsewhere, but you're loaning money to your company, now's the time to say, actually, do we start charging some interest here? Company could potentially get some tax relief on that interest cost, and you're going to get that income tax-free. Stamp duty, land tax. We've had quite a few changes recently since COVID with these, so changes to the bandings, but the main one to be aware of here is that 3% surcharge on second properties. So just being as careful as possible on the timing of the purchase of a second property, especially if you're buying a new home and you intend within 3 years to sell your previous home, need to make sure we get this timing right, because you will pay an extra 3% on the purchase. But as long as the sale of your old home goes through within 3 years, we can make a claim to get that back. But the rules are really tight here. So you really have got to think that through and be very careful with that stamp duty land tax. So you've probably heard the tax freeze in the press. It's a lot of being thrown around quite a lot lately. What it effectively means is that this is going to impact all individuals. Because of the personal allowances being frozen until 2028, so that is a long time for them to be frozen for, each individual is going to feel the cost of inflation a lot more, because we haven't had that increase in the allowances. So personal tax allowance is now stuck there at the 12,570. So any income over that amount, you're going to start paying income tax on. This is where we need to be really careful. Are we utilising spouses' personal tax allowances? Because we're really going to make some tax savings here if we're not using them. A big one, inheritance tax nil rate band. They've still stuck that at 325,000. And then we've got the nil residence rates band of 175. Again, another really big inheritance tax cost there with inflation running how it is. Really need to do some planning around this. If you're looking at your IHT bill, really need to consider the impact of this tax freeze. One slight benefit was obviously they brought out the change in the annual pension allowance. So previously 40,000, we can now pop in the 60,000 a year. And then, of course, the lifetime allowance has now been removed, which means we can put much more into our pensions. Just bear in mind the tax cost if we do go over that 60,000. So capital gains tax, we've known for a little while that they were going to target this. It's certainly been a hot topic between us accountants, that we're expecting changes here. What we saw in the budget is they sliced that annual exempt amount from 12,300 down to just 6,000. And then they've also announced that from April 2024, so next year, it's going to be halved again. So we're going to go down to £3,000 on that capital gains exempt amount. What this means crucially is we need to consider the timings of our realising any capital gains. So what we want to be making sure of, if we're going to realise a gain, we want to be doing this before 6th of April 2024. to use that £6,000 allowance. There's going to be some big shifts in investment portfolios and how they're going to be managed now, because we're losing out on that 12,300 very quickly. They haven't changed the rate of capital gains tax lately. It has been anticipated that it will be something they look at. So currently no changes in the percentages that we're being charged on our capital gains, but we're going to keep our eye on that because it is highly anticipated there's going to be a change there. We've then got your business asset disposal relief, as what most people will know it as is entrepreneurs relief. So we've already had a big change here in the restriction down to £1 million lifetime allowance from the £10 million. And that is a lifetime allowance. So if you are making a relevant disposal, we do have to look back historically. Have you ever previously claimed either business asset disposal relief or entrepreneurs relief? There's some very strict criteria here to be able to claim this relief. And there is some planning involved that we need to do to make sure we can make the most of the relief available to us. We don't want to just assume it's going to be there for us. Again, it's one that has been in the press a bit as to whether it's going to be there forever. We don't know. All we can do is plan with what we can see at the moment. But again, that just makes the timing of your capital gains, timing of these disposals really, really critical.
Thank you. I just wanted to quickly touch on inheritance tax, which is the tax you pay on your death. We haven't got a huge amount of time left, so this is really a light touch on this. And we've done a previous webinar where we've covered this in a bit more detail. So feel free to visit the Knightslow website and follow the link to the podcast and video section. But essentially, I think the takeaway from here is, one, it's very important to understand what your potential liability is, something that's very often left or not looked into, but it's incredibly important to do that. And also important to understand what you can afford to give away whilst maintaining the lifestyle that you want to maintain. I suppose from a small level, you could look at maybe gifts out of income. So if you've got surplus income to your normal living costs, then you could look to give that away, and that would be outside of your estate on the date of the gift, or using the annual gift allowance, which is £3,000 per person. And you can also use up last year's unused allowance. But yeah, I mean, charity gifting, you could also look at as well to reduce the estate. But I think if you have got a liability there, you need to be looking at that in more detail and understanding what you can do to try and mitigate your liability. Shelley touched on pensions a little while ago. As she mentioned, the lifetime allowance has been abolished, so the amount that you can put into a pension without incurring additional tax charges has gone, which is great news for some. And the annual allowance, which is the maximum that you can put in each year, has been increased from £40,000 to £60,000 from April 23. Not forgetting that you've always been able to use the last 3 years of unused allowances as well. So assuming you have not made any contributions in the last 3 years, you're able to put up to £180,000 into a pension, which obviously would save quite a significant amount of tax in your business if you was looking to do that. I think pension contributions might be more relevant now than previous years because of the increase in corporation tax rates. So paying money into a pension, there's various tax benefits, but again, reducing the corporation tax is maybe more of a driver than what it was in the past.
Yes, I'm going to loosely mention these. Tax efficient investments. So ISAs have been around for a long time now. So obviously we've got our £20,000 allowance every year. Really good environment to have that money, tax-free income environment, lots of reliefs available there. So very good place to put some money in and build a habit of putting some money in there. There's also multiple options in terms of share schemes. As I touched on with the EMIs, it really does come down to setting these schemes up correctly, making sure that we put the work in at the start to make sure they are going to be very tax efficient, because otherwise it can fall foul and then you can get some pretty nasty income tax charges on some of those share schemes. So then we've got SEIS and EIS. So these are seed enterprise investment schemes and enterprise investment schemes. So these are typically your more risky investments, but of course come with a higher reward. So for your SEIS, we have a 50% income tax relief available, and you can invest up to 100,000 per year into those schemes. The EIS, it's slightly lower, so a 30% income tax relief, but you can invest up to 1 million in these per year. There are some capital gains benefits in there as well, but if you've got an appetite for these, it's much more worth having a one-on-one discussion to make sure these sort of investments do fit what you're trying to do with your tax planning there. We've then got your venture capital trust investments, so your VCTs. Again, 30% income tax relief, but you can invest up to 200,000 there, so up to £60,000 income tax relief per year. So some really good investments there, or really good opportunities, but you have got to look at them as to whether they fit your individual tax planning.
Just wanted to finish off today. I'm conscious I think we've just gone over time, but just quickly mention succession planning. Incredibly important when we're looking at either selling the business or exiting the business. Important to understand what options are available to you. Is it going to be a sale? Is it going to be a management buyout? Are you going to be able to pass it down to the next generation or wind up the business? And also maximizing the value that you get on the exit of the business as well. There are some significant tax implications of selling your business, mainly capital gains tax. So how much tax do you pay on the sale of your business? And that's where business asset disposal relief, or formerly entrepreneurs relief, can be very important, like Shelley mentioned earlier. And the other impact is inheritance tax. Very often the value of the business will be effectively free from inheritance tax because it qualifies for a relief known as business property relief. Whereas when you sell the business, very often the proceeds you receive won't qualify for any kind of relief. And that can make a massive difference in terms of your inheritance tax liability. Again, I'll direct you to a webinar that's on the website where we've talked about this matter in more details, and we've got some examples as to how that impacts your tax position and some planning opportunities available to you. But if you prefer, feel free to get into contact if you're looking to exit your business and you want some more advice or to discuss what options you've got available to you. So that concludes our webinar. We've had a couple of questions come in, which just quickly pick up on. We've got one on company cars, which, Shelley, did you just want to pick up on that one?
Yeah, absolutely. So question is it beneficial to buy a company car only if they are electric, i.e. not a hybrid or petrol? Typically, yes. We want to be looking at your pure electric or your very, very high electric range hybrids. They are where the best income tax relief in terms of lower benefit in kinds are, and also better opportunities to claim some capital allowances there within the business. So yeah, absolutely, we want to be looking at pure electric or very high range electric hybrids. But if you have a particular car in mind, just let us know so we can confirm the position for you before you sign that purchase or that lease.
Thank you. And just a final one on pensions. Can I only pay into a pension the amount of my salary? Yes, I mean, this is quite a common one for business owners. So you are restricted as well to pay into your pension your net relevant earnings, which is essentially just your earnings. So it's going to be salary or self-employment income. So as a personal pension contribution, you can only put in either your earnings or £3,600 per year, whatever is greater. However, if you're a business owner, then your company can put in a amount higher than that because they're an employer contribution. So if you only pay yourself, say, £12,500 salary through your business, the company can still put into your pension more than £12,500. hopefully that answered your questions. That is the end of the webinar. If you've got any questions, feel free to get in contact. You've got our email address and telephone numbers on screen, or you can find us at knightslow.co.uk. Thank you for your time today. And yeah, if you've got any feedback, we'll be more than welcome to hear that. Thank you.